Hello, active traders, and welcome to Winning Trade Strategies for 2016. Now, this is Ken Calhoun, your host. I'm really thrilled to be joined by my longtime colleague, Price Headley from BigTrends.com. Price, it's great to see you here.
Ken, it's so great to be here with you as well. Thank you for having me.
Great, and I'll turn the presenter control over to you in just a second here. But let me give you a great introduction. Price is one of the three or four smartest people I know in the entire industry. He was inducted into the Traders Hall of Fame back in 2007. He's founder of BigTrends.com. He's seen on CNBC, Fox News, Bloomberg Television, Wall Street Journal, Barron's, Forbes, Investors Business Daily, USA Today, and the Money Show Traders Expos. Anyway, Price is one of the best people out there I know to learn from. He's the go-to guy for options and other trading styles. So really thrilled to share the stage here with Price. As always, all information is for educational or information use. So we're not making advice about to buy, sell, or hold. So with that, let me turn it over to Price Headley. And Price, take it away.
We're going to start with the big picture. I'm an options trader, but I like to start with the overall view of the markets, where the markets are at, and where we're positioned to go. Because as Ken, in his title here, talking about winning trading strategies for 2016, obviously it's been a volatile, nice run back up over the last couple of months here for stocks. You can see off of the lows that we had on the Dow back around 15,500 you saw back in mid-January and mid-February. That matched the kind of flash crash-ish low that we had there in that August 24th big drop day, down to that 15,500 level. And now look at where we are. From 15,500, we just hit over 18,000, just triggered back just a hair under there today. But you can see now, guess what? We're up near the top of the trading range. What I want to show you is how do you take opportunity out of the middle of that trend. That basically, as they say, it's hard to pick tops and bottoms, even though this chart makes it look kind of easy because, of course, it's been a very defined overall trading range. But we're looking at the middle as the easier part of the move. We're trend traders at Big Trends, and we're looking at, okay, what are we looking at? Let's show you real quick. So if you're zooming in to just 2016 action for a second, we started off this year, and immediately we gapped down to start off the year. That's very unusual. And a lot of people were thinking, oh, that's a really bad sign. Well, it was a bad sign in the short term, and you saw we broke to the oversold level. And this is something I want to share with you, is that when I break to an oversold level, I need to see follow through under those lows. It says that it was trying to short there, but that's because it was closing below that prior low. But it was just going into that oversold level, according to the Williams percent R, developed by Larry Williams, a percent range indicator. What I've found is that actually in my testing and in my real-world trading for 2.5 decades, is that the best markets to trade are the markets that keep going down or keep going up. It sounds kind of obvious, but markets that are breaking down and keep breaking down tell you, guess what? The institutional money is rushing out of stocks. It started here, but it didn't get confirmed to me until we broke that oversold low off the first low of the year, 16,957 on the Dow. Closed below there 2 bars later there, 16,906. So it's got to follow through. The trend has to show you that follow through. My latest innovation, actually, that even my longtime Big Trends community has been really excited about for the latest addition into the trading landscape for Big Trenders, is to show these percent R moves as a band of price action. Because you know that if you're stuck in the middle of that trading range kind of a thing, like you had, say, back there in December, top of the range hits the upper part of the range, that's resistance. Hits the bottom of the range, that's support. That's most people's training on overbought, oversold oscillators like percent R, CCI, RSI, you name it, stochastic, etc. You see, that was indeed the case for the month of December. But see how it changed when we hit the bottom of the trading range, kind of stretching towards that lower support. But you can see the support line real closely there around 17,000. And then when we broke it, we see we're starting to then lose that support. And obviously we're headed down to 15,500. So the point is that as we follow through under that lower, what should be support, and then we keep breaking down, that shows you where the trading range, the range trader type view, is not going to work anymore. Now it's a trend trader type of view. That, to me, is one of the most fundamental questions you have to ask yourself in trading is, are we in a range or are we in a trend? Guess what? I would rather trade the trends, in fact, the big trends. But you can see from that point, as we're getting the first sell point on the Dow, 16,888 back there on January 7th, you see it trends all the way down. Where do we get out? Okay, we want to talk about risk management. This bounce where it starts to come out of the oversold area is where I reset my stop. If we close over that bar's high, which was 16,136, we're done with the trade. It happened a couple bars later, and we get out and the next bar's open according to our testing. Everything we do is tested across, how you would implement it in the real world, and then go in and then see how that works. This is TradeStation. You can use all kinds of technologies, but you see after that we're kind of retesting the bottom of the range back here, February 11th, and you see we didn't break that low. There was your double bottom in your classic technical terms, and then now you start to hit overbought. You flip back up real quickly there in late February. We're watching that high, and you see a few bars later close above that high, February 25th, so buying the next bars open at 16,712. Now, that's still below where you effectively started off the year. You see we closed December 31st, 17,425. So you're able to buy the Dow some 800 points lower effectively and miss a lot of that decline if you're waiting for your buy signal. Notice we're below the long-term trend line, but we're now starting to trend. And what I want to point out to you is when we test back into that band, we call these retest points. When it looks like you're coming out of the overbought area, in the early days of my trading, I used to get worried because my testing and my approach said, well, it should stay overbought. But, you're going to get these flushes. One of the reasons I like the %R indicator is it's more volatile. It doesn't look so volatile in the last couple of months, does it? Because we've been rolling like a freight train to the upside. But you can see here that that low was a key low. If we had closed under that low right after the buy signal, that would stop you back out. That low was 16,510. So close under that on the Dow gets you out. Notice sometimes it won't actually show that it tested there intraday, but see that low right here? That was at 16,821 on March 10th. That was another key support. I was screaming about this last one here about 10 days ago on April 7th, where I said, look, that's a classic retest, folks. Dow at 17,484, and everybody's going, oh, but it's come so far. Well, look at what happened. From the 7th here, just over the last 2 weeks, we went from 17,500 to 18,167. Here we are putting on another almost 700 points on the Dow just in a very short window. Now you can use this for any time frame, any type of trading. In fact, as we look out across, now let's talk about tradable vehicles. If you're trading ETFs like the Dow, you could track the DIA. You see, it looks almost the exact same because it's just 1/100th the value roughly of the Dow itself. Well, guess what? If you're a day trader or a quick trader, look at today's action. You see now I've got a couple different bands for a couple different things. So the white ones we're focusing on here for you short-term traders, 15-minute chart. You see the breakdown, follow through. It gave a short today on the DIA at 180.16. Now, if you're a day trader, you might want to just say, you know what, I'm going to place a target if you want to book a half point or target a full point. This one made about a 60-cent move, which is the equivalent of about 60 Dow points. We came near a retest right near the end of the day. The resistance was holding. So it's still bearish heading into tomorrow for a quick trader's point of view. The hourly chart is your swing traders out there looking at about a week. We just ended early this morning a nice swing trade to the upside that happened back there April 12th, DIA at 177.02, and then just got out here at 180.48, up 3.5 points. What I want to do is, I know a lot of you like to trade options, and so what I want to show you here is something that's really cool too. Notice, by the way, that it's not just the %R that we look at. We also look at tools like the CCI on the bottom. When that breaks out above its overbought boundary, on the positive side, the follow-through for CCI the next morning when it closed above that high there, which was just under 178.5, so it broke it right there, 178.47. That was an extra confirmation to consider adding to the position, as well as the retest points. You can see you could have added into the retest, and then the last retest add off of the retest late yesterday was violated in the first hour's close this morning. That's why you're out at 180.5. But what I want to point out to you is if you're an option trader and you get a buy signal on the DIA at 177, which option do you buy? Do you buy the DIA 177 calls? To me, that's not the right choice. That's the more speculative choice. I know a lot of you like to speculate. I like to make money consistently, and I like to reduce risk. And we talk about what's working. It's saying take the lower risk approach. Instead of buying the 177 call, what if you considered buying like the 175 call, maybe even the 174 call? But we'll just look at the 175 for a second. When we're at 177, you can actually see an option chart, and it depends all about your risk tolerance, what you like to trade. Obviously we just had an 0415 expiration, so I'm going to say, maybe you might trade the weeklies that went out the next following week, the April 22nd. And just compare for a second. Remember, we're at 177.02, so we'll call it 177, and watch that straight up and down line here. That's what the option was trading at here, was 280. Okay, and you see it looks a little different on these bands. Notice it didn't break out until we got that follow through the next morning on the option charts. We might have even waited and got in a little bit later because I like to see the option chart really confirming. That went from 385, but it still got up to 639. So, and that next retest, you could have picked it up around 385 as well. So, but the point here is time versus intrinsic value. When you're going back and looking at what we were just talking about here, that it was at 280 and the option's basically worth $2, and you've got essentially about 10 days or maybe about 8 trading days of life to work with here. Now, swing traders usually want to be in and out 3 to 5 days, in my experience. Now, you can swing trade all kinds of different ways, but bottom line is that if I pay $2.80 for something that's worth $2 intrinsically, that means that I've got to make up that 80 cents of time that I could lose if I held this all the way to the expiration. Obviously, you may be thinking, well, I'll be in and out before then, but just keep that in mind. What I like to see as a good ratio is don't pay more than a third of the overall position in time. So if you factor in $2 intrinsic, you're paying $2.80, that you're paying $80 out of that $2.80. So if you do the quick math on that, you're somewhere in the neighborhood of that about 30% range or a little less that basically you're paying for time, and 70% intrinsic. That means if nothing happens and it stays dead flat on the DIA, your option's going to actually cost you that time portion, or just under 30%. Can you stomach that? Well, obviously for me, I'm not going to hang around if I get a violation. So even before the expiration, which is tomorrow, which, in this case, you see you'd be out in the first hour's close today, which again, look at that option chart. The first, if we just put a hover over where that was trading, you can see that quickly, and then we'll go on to some other stocks that we're talking about that option would have been worth, 1 second, I typed that in correctly here, the 0422, see if we're calling 175 is a strike, you see they're actually traded at 566. We were saying probably the real confirmation was about 385. So you would have made like $1.80 on 385, which would be just under a 50% return potential on that trade for about a week's work or 6 trading days worth of work. And that's the kind of thing that as a swing trader you should be thinking realistically about how much you expect to make versus how much you expect to risk. Notice if you buy a retest and you get a quick violation, you have to prepare to kick it out quickly. So let's talk about one of everybody's favorites here with Apple. So, Apple been coming down a little bit recently, right? And this is a 60-minute chart. I always want to encourage you to start with the big picture and then move back down to the short-term chart. So I start with a daily chart. See, the first breakout in Apple came back here in early March. I was talking to a buddy of mine who's a longtime Apple believer. I like to call the Apple longtime holders because they've basically made a lot buying and holding Apple, but I don't advocate that because eventually trends change. No tree grows to the sky. Remember that. So, what I do is I let the chart tell the tale. There's your first breakout. Guess what? Retest right there, folks. See the retest right off that low, 100.40. In my work, it can't close under that. It can trade under there. You see, actually, it does trade under there a couple bars later, the next 2 bars. We call those bend but not break signals. That means that the bulls are getting tested. The bears are trying to see if they can break this thing down. But the structure of this chart is actually up until proven otherwise, and that's a great chance to buy into the dip at a very low-risk area. Obviously, 100's a big round number too, right? You see what happens. It flips up real hard, and notice we're still testing into that area intraday, although we're not closing down there. That's what the %R second chart down here shows you is where the close on %R was of the stock's close in the range of where it's been. But I want to know if it's holding it even intraday. Those are good tests right back there too in late March. And then it makes a move right up here to the 200-day average. This next retest, one more chance to catch another pop, and guess what? Eventually you say, I'm going to be wrong on this. That's correct. There's another retest right there, and then you're finally wrong on it here, and you're down about 2 points on that move, 2.5 points even on that move, and you're out a day later. One of the nice things is when you're wrong, you're not wrong for long. You don't hold this very long. In fact, and I would be a little more cautious, probably would have already booked a chunk of the profits and tightened stops up well past break even so that you're going to position yourself not to lose on that kind of a trade. Never load up on any one trade, by the way. Always make sure you're gradually working your way in, and when you get your exits, always get out of the position and don't hang on and hope. But the point is that there's been a lot of great things happening in this market. Let me do a little quick speed round here to say, you know what, now you got a quick %R education. You factor in gold, for example. Gold has been moving like gangbusters in the first part of the year. Well, guess what? Percent R started to signal here at the beginning of the year as the market got a little bit of that first sell-off in stocks. Notice that signal didn't work. And yes, that's why I use filters like CCI, which told me that that signal wasn't as strong as a more powerful second buy that came on in late January. Now CCI's on board and telling us we've really got a powerful thrust takeoff point happening here, even as it was even just a hair under the long-term average. But the point is that, hey, even if you are just following every percent R signal, you say, hey, guess what? It said the buy price. I bought 105.5-ish, and I got out 103.89. So, even call it a 2-point loss. It wasn't quite 2 points. We'll call it that, $1.60. We say, okay, 2-point loss. And then you see the next one here buys it just under 107. And then when it finally has several retest points, you could have hopped back on the wagon. Last retest holds, rallies, and then this next retest is going to fail. See, there's the retest happening underneath that overbought threshold right there, just barely, and then violating the next bar, getting you out from 107 to 119.73. So call that, it's almost 13 points. We'll call it 12. If you could lose 2 and make 12, make 6 times your risk, even being right only 50% of the time, that would be a home run system that you should follow day in and night out. Basically the idea would be, look, even if it's not as good of a signal here in percent R as the other one in my book, it doesn't matter if you can take your losses quickly and let your winners run, and also know how to get back on the wagon here. This is exactly where you're going to get opportunities in the market. One of the things that's happening too, the dollar has been very weak. The dollar's been in a bearish trend. It's been working down most of the year as you get all the foreign central banks going into negative interest rate territory while our Fed hiked rates. And then just going, maybe we shouldn't have done that. But bottom line is that, from this perspective, that's putting pressure on the dollar. And you can see that's one of the reasons gold rallied. But more importantly, that weakness in the dollar, think about the stocks like McDonald's that get a vast percent of their profits overseas. Well, you think about it and you say, hey, this is a kind of situation where McDonald's has been on a tear. You can see it was on a tear even before that dollar weakness. It just shot up as the market started to rally. Of course, McDonald's is a Dow stock. Do you notice anything happening here on this chart of McDonald's? Look at how many spots you had to re-enter the trend, the retest as I call it. 4 and 5 chances before the 6th one in this case failed. There's no pattern that says that the 5th one's going to fail, or the 6th one's going to fail, or the 7th one's going to fail. It just means that every situation's unique, but the idea is that, look, you get a setup here and this one doesn't hold, and you say, okay, I'm out. I'm in at the close of that bar. Let's say I'm out. The next day, that's down about 80 cents. Guess what? I'll take being down 80 cents if the next trade you get a buy here at 123, and it ran recently before today's little pullback in the markets, or not so little. You say it basically went 123 to almost 130. Again, making more than 6 times your risk versus the last trade in that example. Guess what today is, folks? If you haven't seen it enough times already in this short time together, that's called a retest. Now, am I telling you to go take the second and third mortgage and leverage the farm on one trade? Of course not. I'm saying this is just setting up that support here at the low today should hold if the pattern is to hold. Now, yeah, we may run into a little bit of trouble if it snaps from 125.79 up to 127.5, and so that might be a first place where you take a little bit off if you're a little more risk averse. But the idea is that we're getting a structure here for where trends happen versus where ranges happen, and it's the same way on the downside. One of the big downside ones that we called last month, and it's been one that's been developing for a while, Valiant Pharmaceutical. Wasn't really a household name for a lot of folks, but this was a stock that had run up a ton in the past, and then all of a sudden all these issues come out about how they book their revenue, and et cetera, and you can see, guess what happens? You start to catch major breakdowns below the long-term trend line. Next breakdown. This is where I would say, look, I'm very cautious about taking a buy signal, not only if the CCI is not confirming, but if we're below the long-term trend line. You see just how much pain has been caused. So this is why I always say, keep an eye on the long-term trends. It'll help you to stay on the right side of the move. We want to align the rivers of time, short-term time headed and price action headed down, longer-term price action showing the rollover there. We tend to line ourselves up that way. Volatility is one, by the way, and of course, you can convert that into options, right? So volatility is one that we want to pay attention to here as well, because guess what? Volatility is very low right now. But guess what? It predicted that it was going to go in a downtrend back here, and we got a sell on VXX, the volatility ETF, 22.79, and here we are now at 16.5. So that volatility has been good for stocks as we come down, but we have to factor in that the recent test just under 16 looks quite a bit like the times where we've gotten down into the same area like we did last mid-July to mid-August. You know what happened in later August. The market took a big hammering quickly, and volatility levels more than doubled. So, yes, there's opportunity there to pay attention to it, but we want to wait till we see those trends start to really reverse before we really get that opportunity to buy into volatility rising. So don't try to be too early. The trend is still down, but I'm saying pay attention. The volatility levels are relatively low. That's good news if you like to buy options. So my point would be here that, part of what we do at Big Trends is we're big believers in scanning. So, I can go and just hand pick, you could type in symbol after symbol, even click on hundreds of symbols. But you know what I say? I say, what if we could take a database A to Z, and we could actually go in and just say, hey, show me a scan page, show me all the A to Z symbols, and let's just rank them, whether it's by %R, bull and bear, whether it's by CCI, whether it's by bands or whatnot. So if you look at the strong bullish candidates, we start to see, guess what's been starting to pick up lately? Drug stocks and biotech stocks, Bristol Myers, Celgene, a whole lot of different names. These are not recommendations, of course. These are just showing you how we start to come up with ideas. I code mine so that yellow means it's actually just now starting to go overbought, like Biogen, one of the other biotechs did today. That's not a buy yet. So basically, I wait and see if it confirms in green or not. And then also what I do, we had a pullback in the market, and so what I also look for are retests, as I mentioned earlier. Retests are in red where we're coming back down, so you get stocks like CMI, GME, no recommendations here, just setting up the first starting point. Baidu. Remember, it's earnings season too, so don't step right in front of earnings. See, here's a fake out, like Deere. Deere went overbought yesterday, got into the overbought territory, and then it shot right back down under 80, under the overbought threshold. That to me means I don't touch it. Okay, so and we go look at were there any fresh breakdowns on today's big market drop. We flip back to the weakest names in the bottom few percentile, and you see stocks like Monster, MNST, Ciena. You're starting to see those green ones go. Those are bear confirmations. Utilities actually breaking down pretty hard. That had been a really strong sector, XLU. And so the point of all this is just you're setting up, and surprisingly, you're starting to see some decent breakdowns. Michael Kors is another one that just broke down the retail sector over here. So you start looking at those, you start looking for opportunities. So when I take that idea, then I can literally go in and say, okay, so go and I look at a stock like, pick your name, Michael Kors. You say, yeah, it broke down on the daily a little bit, but it's not really that confirmed it's above the long-term trend line. So I keep on looking. I look at Monster, and then again, I want to factor in being, and that's looking more bearish, right? That's below the long-term trend line. It's set up oversold, and then it followed through to the downside. You see a couple of the last times that's happened, fairly quick moves on the downside in short order. And so we want to keep that in mind. One of the things that's been on everybody's mind is oil prices, right? You've had oil, USO, the big ETF that tracks oil. What's amazing to me is how it took forever, it seemed like, for people to get on board that oil was going down. I mean, I've been talking, and it's improving a little bit recently, so it looks more positive in the short term, but below the long-term trend line, I would grade that mildly positive for oil prices firming up, but not calling that a big trend yet. But you look at it and you say, go back, not just to last year. You see how steady that downtrend was last July and August. You got to go back into the middle of July 14 and see where we started to break that long-term trend line. And that first signal was nice, but boy, that second signal, October of 14, was really nice. You see that the ETF went from the 30s all the way down into the mid-teens before it finally gave a buy and cover there, just under 19. And you see, sometimes you'll be wrong. So this one gave us short, and then looked like another good short, 16. That one stopped you out at 17. That was down $1. But like I said, if you can lose $1 and then say your next sell signal at 18.30 goes down to 12 and then stops out back at 14.60, you say, look, I lose a point, I make 3.5 points. That's a great reward to risk ratio. That's how you need to be thinking. So as I said, when I convert these ideas into option ideas, let's just go back and talk, for example, about a bull example, because we had that bull retest on McDonald's, for example. And I'm just for information purposes only, just saying, if you're looking at McDonald's and you're saying, well, gee, the stock's 125.5 after hours, it's below where price says it shouldn't be below that area. Well, I'm saying it's got to close below there tomorrow or in a future day to violate that 125.60. I do not recommend the 125 call, because if you look at that option, you say, you know what, clearly say you're just looking at the May options for a second off the daily chart, and if you look at the at-the-money options, these options have a lot of time in them, right? They took a beating today. That's the retest that we're talking about. But what I'm suggesting is, it looks like awful on the chart, doesn't it? That awful-looking candle. What I'm saying is that retest should hold on the stock. The option chart, of course, though, shows you the time portion of the trade as well. When we're just about halfway in the money, this option's got about $3 a time in it. And what that means is that if you're just waiting around for something to happen and it just ends up flatlining on you, you could lose practically all of your investment in the 125 call. In comparison, just even the more conservative 120 call, just for just a really conservative example, we're 5.5 points in the money in the 120 call, and the option's trading for a middle of about 7. That means that of your 7 points that you would pay, that's only about $1.50 of that 7, or just over 20% of that option is time value. Which would you rather lose if nothing happens? Say 20 or 25%, or say 85%? The idea is you got to think in risk versus reward. Don't just think in terms of what you can make. Think in terms of what you can lose if it doesn't pan out like you expected. So that's really important in my work. So, of course, we've had an amazing environment for bonds, and we're talking about the rest of 2016's outlook. I want to show you a long-term chart before I hand it over to Ken here in a few minutes, because I'm excited to hear what he has to share as well. Bonds, obviously had that great run when stocks are plunging, all the money's rushing into bonds. That second signal obviously gave you a really nice move in TLT from 126, 135 peak, stopped out at 129.64. Then we've been back in the trading range. This move looks like a buy, but actually my rule is really picky, which says that when we go above that overbought threshold, we must either stay above it and confirm above that high. Didn't happen. It flipped back down. So then we start all over. Then it has to take it out. Just the coding picks up that, it's closing above that prior overbought bar's high, but I'm picking, I say it's got to make a fresh new confirmation above this high at 132.99. Didn't happen. So I wasn't interested in that one. Notice it hit overbought again, and then wham, bam. It is not a thank you situation. If you're bullish, it's very thank you. If you happen to convert this and say we're top of the trading range, we could actually trade this either on an hourly chart here or down even on your 15-minute chart view, quick traders. There's something for everybody here. And the point is that, but what's interesting is what I've done even on these short-term charts is I showed here yesterday how we were getting the breakdown. And yes, CCI did not confirm that prior breakdown. It did confirm this breakdown right as it followed through to the downside. That's why I use that confirmation of CCI to back up my percent or my band read. So from this perspective, we're getting confirmed about that close 130.5. Notice where it hits. It hits right back into that long-term light blue line, which I've essentially converted. If you take a step back for a second, notice anything about the light blue line here on the daily and the light blue line levels? 128.37, can't quite see it there, 128.37 on the daily. Yeah, guess what that is? I've converted the daily equivalent into the 15-minute chart to show multiple time frames on the 15-minute. The yellow is the hourly time frame. Notice the hourly bounce this morning was resistance for TLT. Guess where the support was? Off the daily lower support. So the point of this is, where's the sweet spot? It's right through that window as we crush below both the 15 and 60 minute, and then as we gap down this morning, you're done on your downside. You should be booking profits, or at least booking part of your profits on your bear trade, and then going from there. So the bottom line is that there's something in here for everybody, and there's all kinds of ways to make money in this market. In fact, I can't wait to hear what Ken Calhoun has to share with us as well, because Ken, I don't know anybody that's more passionate about the trading game, in my view, of all the educators out there. I would put Ken right up there with me if I could pat myself on the back. Oh, my arm hurts from. But basically, no, Ken does a fantastic job of really letting that passion translate into all kinds of ways you can be taking advantage of today's markets and trend trading. We share a passion for education, and so I want to say I am so excited, Ken, to hear what you have to say about what's working here in 2016 and what you expect to continue to work as we move our way through this presidential election year, through the summer, into the fall, into the elections, and how to profit from it.
All right. Well, hey, thanks so much, Price Headley. You're one of the most brilliant people I've heard. It's always outstanding to see your thoughts. And whenever I learn from a top industry expert like Price, I always like to look not only at the technicals but the thought process behind it. How does this trader approach the markets? And you've got an absolutely brilliant technical look at the market. And I really wanted to thank you for sharing. I highly recommend Price Headley to all of you to learn from. He's one of the. I'm very picky. I'm very protective of my traders, and I work with a very select group of people who I actually trust. And Price Headley's up at the top of the list there. He's one of the best people you can learn from. So thanks so much, Price Headley. Be sure to go to bigtrends.com/free for those of you who are not yet on Price's email list. You can learn more from Price Headley as well. So
thank you, Ken. I appreciate it. And I just made you the presenter. Always a lot of fun. I can't wait to hear what you have to share, too.
All right. Well, thanks so much. Can you see this okay? I just wanted to double check everything looks
Yes.
All right. Price was mentioning VXX. It's good minds think alike. And I'm also keen on the bounce in oil right now. We're going to look at a lot of the top charts. As a real money trader, I like to show examples of that. For those of you who are new to working with me, I'm a regular columnist now for Stocks and Commodities. So you may have seen my series of articles lately. I'm in CBS Market Watch, well, from back at the dawn of time. And also speak at the Money Show Traders Expos. Tonight, we're going to look at scanning for successful trades with the strongest intraday and swing trading charts. And one of the things that I want to make real clear for you is the difference between those kind of charts that work and those that don't. And this is kind of it for my PowerPoints. I'm a big fan of Price because, like me, we both work off of live charts. We know how to trade, so we're not PowerPoint jockeys. We're actual real traders. So let's take a look at what's moving and how to trade. Here's our S&P. One of the first things, you may want to take note of these. One of the first things I want you to do is start looking for the difference between charts that work and charts that don't. You can use these for your directional options as well as stock swing trading. We're also going to look at some of the top day trading charts too for things that ran up like Viacom today. If you bought that on the open range breakout, 38, 38.50, like I teach in my live room, it ran all the way up to 42 today. So those are the kind of charts you want to work on. Minor breakouts above previous day's highs. One of the things I want you to look for from a swing trading perspective is the best of the charts using visual candlestick pattern recognition skills. And I'm going to walk you through these charts on 2 time intervals. We're going to go through the 90-day and the 15-day shorter term time intervals so you can see the differences between just how much money you could potentially make on these charts and the difference between these and some of the others out there. My favorite pattern is always going to be minor gap continuations. Now I don't see any particularly strong gaps here today, maybe a little one there. Second to gaps is wide range candles at the right side of a bullish cup. And oftentimes you'll see that if you put a buy stop order in 50 cents above the high of that candle, that often gets you into a nice winning swing trade. The trick is understand the difference between charts that have enough volatility that are worth trading. I know Price, any good trader, Price, myself, any of the top industry guys, we're always keen on charts in play, is what Wall Street, my institutional guys would call it, charts in motion. A quick filter is make sure it has at least 10% price action range on a 15-day chart. So $20 stock with 2 points or better, $50 stock with 5 points or better. Like Medivation, you can see this thing 44 to 54. It's got a 10-point range on a $50 stock, just over 20% trading range. So that makes it a good candidate to be worth trading in the first place. You can see a sequence of gap continuations. Gaps up, continue up. The gap up continues up, so forth and so on. So one of the best things you can do for your own personal trading success this year is be very selective and hone in on the very strongest high velocity charts that have the best trend strength. Now, one pattern that I've published on in Stocks and Commodities and Active Trader magazine earlier and spoken on at the Money Show Expos is what I call an acceleration ramp. I know Price has acceleration bands. I use acceleration ramp. And the same thing, you're looking for increasing heat. And it's kind of a hockey stick approach where you see a maybe 30 to 40 degree uptrend that then makes a nice 45 degree angle uptrend. That tells you've got increasing institutional volume and volatility. Look at the volume profile here post large candle compared to the nice steady uptrend pre-breakout. Okay, you can throw darts at this stock, all day long and do well, whether you're trading options or the underlying. I am mostly a directional stock underlying trader. I don't trade the options, I trade the instruments. But either way, you're looking for strongest volatility and separating out the easiest to make money with charts potentially from all the rest of them. Look for a story. Look at it like, if you're like me, I'm a fan of Hollywood action movies with lots of fast cars and the rest of it. And one of the things I'm looking for is an increasing story of new buyers coming into an instrument. I'm always keen to make money by buying high and selling higher. One of the quick filters to avoid false breakouts is to use 50 cents above the nearest whole number high. I've taught traders how to do that nearly 20 years now. Tens of thousands of traders have learned from me. It's a very popular strategy, a filter. So 55.50 would be the first long. I like to scale in on my stocks and ETF swing trades roughly 2 points. So I might do 100 shares at 55.5, another 50 shares at 57.5, and so forth and so on. You always look to get into an initial trade with the underlying goal of being to scale into it. Every trading decision you make, I've traded millions of dollars worth of stocks and ETFs. I know how to trade. Every single trade you make has to be with the goal in mind of, like the price taught too, it's exactly right, of scaling into, or as my colleague Van Tharp would call position sizing, or scaling in or adding to a trade. The way that I've done that is very successfully is to start all trades off small size, maybe 20 or 50 shares, 100 shares, a little itty bitty pilot trade that then snowballs. Every couple of points of price action I can then scale into it. So look for a story of increasing buyers. One of the easiest, and one of my upcoming articles in Stocks and Commodities will be on multiple gaps, and one of the things you look for as a professional trader is a story of imbalance, kind of like I buy a lot of old rare silver and golden coins on eBay and antique saxophones and all that. I play horn. Anyway, it's like they're bidding it up and they're so excited they just can't wait to get in. And institutional buying pressure is seen by minor gaps. Now, odds are, if you're like me, you got, well, maybe I don't have a life, but you guys all have a life. I work these 16-hour insane days. Well, anyway, if you've got a life, odds are you're going to miss the first gap. That's fine. You're going to get another shot at it, even a third shot. A sequence of continuous gaps is always the single best poker tell. I won my first Vegas poker tournament 6 years ago. Anyway, it's kind of a poker tell that institutional buying volume is coming into that instrument. So visually, a couple of things I just taught you are really easy to look for. Now you got obvious things like a hammer off a moving average line following a minor downtrend, right? Or a bullish engulfing. And for more on candles, be sure to learn from my colleague Steve Nissen, the world's top expert in candles. Anyway, you got a bullish engulfment, you got a hammer, they work. But let's say you miss it because you're off doing something else. You're busy. Well, one of the best volatility indicators is to look for a candle of at least 1.5 to twice the whole real body height of the preceding 2 or 3 candles at the right side of a congestion or bullish cup pattern, and then you set your entry trigger. And this is a very effective pattern. I've done this for so many years. It works. And kind of that's it. The neat news is it's consistent, it works, and there's no more magic to it. It's very easy to duplicate. So that's the kind of trading technique you want to test out and experiment with in your own test. So wide range candle, right side of a cup. This is they're all uncertain. They don't know what the heck they want to do. Here, they're awake. It's kind of like back when I had a 77 Olds Cutlass and the thing would always die on the side of the road and I have to get AAA and jump start it. Zzz, okay, well, we're alive. It's alive. You go on long 50 cents above the high and you're off to the races. We're going to look at some of the inverses and the oil instruments in just a minute. But first, let me give you an example of a chart that would be absolutely horrible to trade. Acadia Pharmaceuticals. Now it's a nice run up, and you might be, interested in it because, hey, it did this big run. Maybe it'll go up again. No, 2 epic fails. Shooting star, so obviously inconceivable. I'm a big fan of the movie Princess Bride. I've only seen it like 30 times. Anyways, inconceivable you would buy here because that would be a boneheaded buying to resistance. Anybody who's long will happily sell to you there. So if you get false breakout up here, you don't want to buy that. The other tell, in addition to shooting star, is I like the fact that it recovered the 200 simple moving average. So that's a plus, but not ready for prime time yet. Live from New York. It's Saturday. No, actually, it's Thursday night. Anyway, all these flat melted candles. We've got a doji. We've got undecided whole real bodies. We've got a Christmas tree green red print. The story of this instrument is it's going to bed. It's asleep. So what I want before I go long is another candle of about this height parked up over here, and then I'll hit it long, maybe up there. But for now, we stay clear of it. And you don't trade a new high because you have 2 opposing signals. One is an obvious shooting star, which if you map out the data points would be a bearish cup pattern. And the other is the undecided nature of the traders there. So don't fool around with instruments that aren't likely to make money for you. What you want to do is make sure that you're focused on these strong trending instruments that have good, as I'm a fan, as is price, the strong trend strength. Okay, you can see a large whole real body green candle here. That's yet another signal. And visually, one of the best things you can do to train your mind as a trader to become more successful is kind of just do an if-then Like open up, my favorite application is the simplest one, Notepad, and just kind of the passage of time. How would you trade this? Okay, there's a large green candle. What do we do? Well, you go in 50 cents above the high, that being maybe 37-ish or so. And it ran on up to 41. Use a maximum 2 point initial stop on all swing trades, or a 2-day low, or if you see 2 red opposing candles. There's a lot of reasons to get out of trades, but as long as the trend is there following a signal candle, even if you missed the first one, which would have got you in here and 50 cents above the high, you got a second shot at it. And they continue to run. This is SEMO, the chart. One of the best things you can do as a professional trader, and my biggest money-making trades I've made in my career have all been trading outlier strong charts, kind of like obvious charts, right? And that's what you want to do is if you have to guess at it, it's not worth trading. You want trades that are obviously successful ahead of time. Like, what's the right side of the chart likely to do? Well, 3D, I might hit it long at 20.50 and again at 22.50 because we've got such a steady preponderance of buyers. There's no sellers of significance in place here, so for that reason, I'd be in, right? As opposed to Acadia. If you're fellow fans of the Shark Tank movie, for that reason, I'm out because it just doesn't fit my portfolio. And I don't know how I could help you grow the business. And you can't scale. Well, you can't trade and scale this thing up either because it's in a sideways congestion box. So just say no, stick a fork in it. Instead, focus on the charts that have better potential. So just to illustrate the point that you often see gap continuations, my favorite play is always buying above the high of a gap day. Obviously, you're going to miss a lot of the gap days because you're off doing something else. The good news is there's ample opportunity to get into them on subsequent trading days. Okay, you can see a nice, what do you see here? This is another pattern I'll give you. These are kind of whiskers or bullish lower shadows, all right? Even though this is not a hammer because it's not at the bottom of a downtrend, it is still bullish because the lower shadows tell us so. It's kind of like whiskers or a bearded growth down there is a long pattern, and even if you didn't get in there, you got a nice minor gap continuation from 31 to 34, a nice 3-point runner. You could still chip away at it anywhere here, and same for if you're a directional option trader. Use these types of visual scanning strategies. I'm a price action breakout professional. That's what I do. You're looking at making money on buying subsequent to the signal day. So even if you miss the big day up, you almost always get multiple opportunities to trade on a subsequent trading session. ETP, another good chart. If we look at the shorter term interval, this is minor gap 1, minor gap 2, price action acceleration ramp. The force is strong with this one. Just say no, Luke. It's a minor run up and it continues on up to new highs. It's so easy once you understand the difference between things that you can make money with and things that you can't. Okay, one of my favorite chip stocks I've been calling long for my traders at Trade Mastery for the last 3 months has been NVIDIA. It's been the lead chip stock, right? The semiconductor makers of fine graphic cards, powering my own computer, as a matter of fact. Anyway, minor gap continuation. Even if you miss that, a new trader, remember back in the 90s when I was learning how to trade, I'd always think, well, I don't want to be the bag holder at top buying a new high because surely it'll drop right back down into support zone and I'll have overpaid for it. Nothing could be further from the truth. And it took me 6 years to learn that the hard way. Blowing up 2 trading accounts. I've made every single mistake in the book and then some. But I learned, okay? And so can you. The trick is, the setup is minor gap, maybe you missed it, okay? Well, it continued on up, wide range candle, there's no reason to miss out on that one. Another wide range candle above the high. You got bullish lower shadows. So even if you still dithered around and didn't get in long, somewhere over yonder here, I'm in Colorado, so I can say yonder. Somewhere in these here parts, we know that this would make for a good breakout. And around 34 to 37. Now, we have a bearish engulfment here, so we don't want to go long yet unless it takes out new highs. And again, a good false breakout avoidance filter. Visually mark out thou shalt not from the rest of your trading life. Never trade inside range charts, which are choppy inside the previous day's chart. This is a 2-day chart. Thou shalt never enter new trades when it's inside on an in. Wall Street talk is in days, like when the S&P or the Dow is on an inside previous day's high-low range. that you should never enter new swing trades or directional option trades if you're on an end day, because institutional volume doesn't know what the heck they want to do. So stay out. When in doubt, stay out. Instead, draw out visually a nice false breakout filter. And again, I publish on this in my stocks and commodities articles because it works. I was trying to figure out the difference between what I've made in my own real money trades and the success stories versus the fails. And then how do you capitalize on that by setting up trading strategies that actually make sense. Anyway, don't trade within the first 50 cents or so. And again, I like instruments in the $20 to $70 share range. If you're trading a $90 or $100 instrument, you may need to use $1.50 or $2 as the false breakout filter. That's a right or downer, and then true for directional option trades too if you're trading Apple or some of the higher priced instruments. This is my domain. I hate penny stocks because they're stupid and they're choppy and they go up and down like zigzag patterns, and you're just going to blow up your trading account if you trade stupid penny stocks. So don't trade stupid under $10 stocks. That's a really dumb mistake. And fortunately, I didn't learn that the hard way. I'm a classic .com, one of the original .com day traders. Widely imitated, never duplicated. I used to day trade things like DoubleClick was one, and Staples and WorldCom and all those back in the 90s. Well, I like instruments that have some juice, some volatility. Anyway, mark out visually 50 cents above the breakout current resistance area and resolve never to buy there, because that's where your market makers and specialists like to get the better edge of you. And if you've ever done this where you've bought, hey, I don't want to miss the run, I'll get in, I'll buy 37.70. It runs up to 38, immediately starts to drop, you get stopped out at 36.5 or so, and then it runs to 45 without you. Can all raise our hands. When I do my money show presentations, every hand goes up. It's like, yeah, we've been there, done that, got the t-shirt. Let's figure out how to make money instead. So anyway, put a false breakout filter above highs. For example, XIV, a nice directional. That's our inverse VIX, right? That's the opposite of, if you want to go long the market, I buy the XIV. It's much better leveraged than instruments like, because it's only 27 share, much better leverage than, say, the spiders at 200 or the diamonds or the Qs, whatever. Those are great charts, but they're really expensive to work with. I'd rather only spend 25 a share and still get a nice big run. 16 to 27, a 10-point run, a nearly 50% run on a high 20-ish stock. Anyway, or ETN to be exact. It's testing resistance at the 200 moving average. Always use the 50. Breaks above the 50, that's a good long signal, 50 cents or so above that. Same thing on the 100 simple moving average, same thing on the 200. Quick, another tip, don't buy nines. Maybe not as sensitive in the index tight instruments like this one, but nines usually look a little rich to the crowd, and so people will sell there. I would be more cautious, and I would not buy the XIV. Again, not a trade recommendation, but not trade reco, but that's where I'm going to look at to get in long. 30.5, and again up at 32.5. Okay, now if our market sells off, which it may well do because we have a 3-day uptrend in UVXY, I know Price had mentioned VXX, I trade both of those, and XIV and SDS and others, but I like the volatility in UVXY. We'll look at oil in a second too, but because we're in a 3-day trend, it's not really strong enough yet, but you don't want to buy a dead cat bounce. Bad news, bad trader, don't do that. Not yet. It's not good enough yet. What's good is, and Price did a good job of explaining back on the prior VXX support, that's smart. You always look at longer term technical support resistance because that's what professionals do. We're looking at prior support lines, right? So here, a relatively somewhat safer bet would be to wait for it to recover previous support, which is current resistance, somewhere north of 24, and then get the party started by going long in these instruments once they start to recover the 50, 100, and 200 moving average line. Okay. But back to momentum charts. What do you do here? I'm not a big fan of pivots, but the earliest you want to do a pivot trade in what had been a really strong uptrend, PGR, a really nice runner from 30 to 35, is wait till it recovers moving average nearest whole number. So somewhere north of 34 would be the earliest you'd want to get in long. You don't want to try and catch a falling knife. Ouch, that hurts. Having done that multiple times and learning the difference, you start to get a real clear sense of the very strongest charts and everything else. So if something takes a dump and it goes down here like this and loses support under the 50 momentum moving average line on a 90-day chart, You don't want to do a pivot trade until at minimum it comes back to life above that moving average. That's going to be the first speculative long. A better long would be up to north of 64.5. So making sure that you're staying clear of charts that are in trouble and only being directionally good charts like CPXX, another good one I've been calling long for my traders since I didn't get on it till late March, till here. I breakout above this pullback. But anyway, this one, so I missed this first initial run, but I got my traders in over here and it ran up, a few points. So if you do trade a cheap instrument, make sure it's got a nice 45-degree angle sustainable uptrend, which is rare. The cheaper the instrument, the more susceptible it is to pullbacks and speculative, penny stock promoters or morons running chat rooms saying everybody sell it, and then you got all these sheeple out there shorting cheap thin float pennies. Don't screw around with that. Instead, trade stronger charts that are more sensible and more likely to make good trades for you. Now let's take a look at some of the directional charts on the 15-day. I guess the first thing I want to do is tell you, Price had mentioned USO. I'm long USO. I'm also long UCO. And I'm long oil. And I'm long UWTI. Those are the 4 oil picks, the 4 horsemen of the oil recovery apocalypse. The force is strong. Let's see if it continues to run on up, right? We got some rock star charts. UWTI, one of my traders turned me on to this one. It did a 20-for-1 inverse, it's a reverse split. It had been way down at a couple bucks a share. They did a reverse, and it's been on a run ever since, going from 18 to 28. UWTI, UCO, oil, and USO. My Fidelity won't let me trade oil anymore. They said it's, for some reason, they're not allowing new trades in the oil instrument. But anyway, I'm long all 4 of those for good reason, because they're good uptrend continuations. Now's a good time to, again, not a trade recommendation, but now's a good time to start looking at the oil sector. And the reason is, and Price said wisely, you find this, there's convergence among, best and the brightest and smart people who know what they're talking about. We'll tell you some of the overlapping things that you need to pay attention to. My eyes are on this prize. I expect to make a lot of money in the bouncing crude. Now, if it starts to stall and this is a dead cat bounce, and it keeps going on down, okay, I'll go ahead and take my small profit and be done. But if it keeps running on up, look at the profit potential. This is USO. Look at oil. They're all the same chart, so you can diversify. UWTI is also UCO's larger leverage, right? Look at that one. Now these are very speculative, and I'm very speculative for bounce plays, but look at the upside potential. I mean, just look at that. And these are all regular, oil ETNs and ETFs and whatnot. So the USO is a good one to focus on, the US oil fund. We got a bullish engulfing that didn't hold, right? Sometimes the candles don't always, they're usually correct, but sometimes, they're not always right. You got a bullish signal here, but then it lost support over here, and that would be a sell signal. That would be a buy signal. That would be a sell signal. So that would have been a wrong bounce trade. I still like the fact that we've got a hammer down here. It's trying to hammer out a low multiple places. Hammer time, uptrend continuation time lately. But look at the profit potential, right? 11. Usually I'll look for 50% retracement, reversion to the mean. So exit target for this trade would be to scale in over 1150, again over here, and exit right under the 100 moving, or tighten in a trailing stop to be more accurate, right under the 20. So if I can get off a trade and near double my money, that's worth it. And then I can rebuy. It'll likely stop and stall and chop around here. Rebuy if it takes out new highs above the 100 moving average after it does its song and dance and pulls back, and then yet again over the 200 moving average. But this type of pattern, very risky for now for a bounce, but it is starting to show some promise. And for that reason I'm in, because it's going up, and I'm a trend trader, right? Like Price. A good trader is always trying to make money on the best directional plays. And as you see the difference between these charts and everything else out there, I hope this is giving you some insight in terms of volatile signals and the types of patterns to look for, right? It's very intelligent. When you look at, and I like the 90-day candlestick chart, you look at signals like a big wide green candle, you wait for 50 cents above the high to avoid a false breakout, so you wouldn't have been in here. See how smart that is? That was the exact high here. Would have been a false breakout there. Amateurs who don't know how to trade would have bought that and got, oh, darn shucks. Then it runs up without them. Okay, smart traders were in from 50 cents above the whole row body candle high, which would be 40.50. It's starting to work out, so we'll see. To be determined, to be continued. Avoid charts that have a sign of congestion or bearish upper shadow or shooting star, and instead selectively focus or target your energy as an intelligent, profit-seeking trader on charts that have emerging new volatility and are taking out new highs consistently. Look at charts a lot like people, and this is a very good lesson learned. When you're a younger person, speaking from experience in your 20s, you may end up in personal relationships with all kinds of people, and you take all kinds of jobs, and you're not really too particular on the specific apartment or house that you're living in, as long as it looks halfway decent. Or if you're a manager and you're making hiring decisions, you may not do reference or background checks as much as you should if you're a new manager. The more experience you get, you know what kind of questions to ask, and you know to look into the past of the people and the situations that you're considering engaging with. It's always best as a directional breakout professional trader, I always do, is looking for a story of nice expanding trading ranges with higher price action volatility, right? And if you just kind of eyeball the chart, another quick tip is if I were to mark out the ATR indicator, and I remember Price did a brilliant presentation in Dallas at the Expo on ATR indicator. Anyway, if you were to mark out an ATR indicator, you would likely see it trending up here because we have a tight channel with narrow trading ranges and larger trading ranges recently. So for that reason, it's kind of in heat, or it's a volatile chart. Another indicator you can use is that ADX, and I've published articles on that forever. What I like is ADX breaking north of 40. The red ADX signal line getting over 40 tells me we've got a chart that's hot, that's in heat. The ADX signal is just a volatility indicator, and you're looking for an increase in ADX accompanied by an increase in price and volume is another confirming technical to get you in on your trade. So I don't have time to go over ADX much tonight, but that's another decision support tool you can use in addition to your simple 50, 100, 200 moving averages on these 90-day charts, or nice clean expanding ranges on uptrend continuations on your swing trading charts. So let's see what else I can share with you today. One of the things you always want to be keen on is understanding classic cut pattern breakouts with the expectation there's going to be a handle or an uncertainty zone at the right side of a cup. That's kind of just technical analysis 101, but my best winning trades are always going to be cup breakouts and or gap. My best trades are gap continuations. My second best are cup breakouts at new highs. So you see a bullish cup, it's going to chop around here, hence the 50-cent false breakout filter that gets you in. Another bullish cup runs up. So train yourself. What I'm trying to tell you is train yourself to visually mark out cup patterns, because they are the ribeye steak. I like a good ribeye with garlic mashed potatoes and grilled prawns, but I digress. Making everybody hungry here. I always like eating steak and lobster tails. Anyway, the point is, bullish cup breakout, we had a nice large green candles here, even on a 15-minute candlestick basis. And a bullish cup breakout that led to new highs with an expanding trading range, right? The average true range here, this would be kind of a flat candle, flat candle, flat candle. This is a big candle. This would be another big daily candle. And you can look on the daily chart just to confirm that. But that's the type of chart that you want to engage with. Half the battle, whether you're doing directional option trades or classic stock swing trading like I do, or day trading, is all about looking for the choices to the charts out there. And speaking of which, if you are looking for intraday trades, make sure you're looking for these charts that are outside the previous day's range. Just my closing thought for the night is, if you want to do yourself a big favor, and for proof, subject everything that you learned from smart people to proof and validity, go back and look at your last 30 stop outs. And I can pretty much guarantee that most of them initiated somewhere inside a previous day's range. Instead, from now on, wait till we break above a whole number high outside of a previous day's range. Those are the charts you want to engage with for an intraday swing or a multi-day swing or a day trade. Your best money plays are always going to be multi-day breakouts. So anyway, with that, I'm out. Be sure to learn from Price Headley at bigtrends.com. I'm Ken Calhoun at Day Trading University and TradeMastery.com. I'm migrating my business over to TradeMastery because it sounds cooler. And it's shorter, and everybody copied my university idea, so They're starting to copy my mastery idea too, but I'm ahead of them. So anyway, get out there and make some good trades and keep your tight stop, keep your powder dry. On behalf of Price Headley from BigTrends.com and myself, Ken Calhoun at TradeMastery.com, wanted to wish you the best for successful trading moving forward. I will get the video up to the server later tonight. It's not there yet, but that will be where it is at, and I have that link. There's nothing there yet, so don't click on the link, but bookmark that link, and there will be a video at that link coming up either later tonight or first thing in the morning. So y'all have been amazing. Thanks so much for being here, and on behalf of Price Headley and myself, I want to thank you so much for being part of tonight's event.